Good morning. Another week. August 10th. Wow, time flies. While we give people an opportunity to join, let's get caught up on this week's events. Nothing today. We've got weekly ADP and home sales tomorrow. Wednesday, Fannie's roll. Of course, NBA apps. Sort of the big data point for the week as far as the world is concerned. CPI at 8:30. On Thursday, we back that up with PPI and claims. And then Friday, for me, really the highlight of the week, be, for a myriad of reasons, not the least of which is that we're potentially really reporting on sort of stale inflation data in the context of Iran, is going to be retail sales. And seeing some employment weakness on the retail side. One thinks that lines up for a miss, and then you have Michigan sentiment. And then next week, we roll dwarfs on Monday. On Tuesday, we have some housing and weekly ADP. We roll Ginnies on Wednesday. Fed minutes. And I'm not a big minutes guy, but these last two or three meetings, outgoing, incoming, and then sort of the dissension. So to get some language behind that could be useful. So I am looking forward to next Wednesday at 2:00. Philly Fed Thursday, claims, and then Friday S&P. We open up with bonds a little bit worse. We sold off into the close on Friday, unfortunately. Talked about not being, when this number hit Friday morning, and I'm going to quadruple down. I mean, it was just a great report for rates, a terrible report for the economy. But I said, hey, I don't think this is it, right? And now I kind of felt like it had enough juice to take us into the close and maybe even through today, but it didn't even have that much. Overnight, we saw Asian stocks and European stocks generally do better. The FTSE was worse. Mixed here onshore. S&P, NASDAQ indicating up, Dow, Russell down, gold down, VIX up about 3%, Bitcoin up. And I don't want to say inexplicably, but I don't know that I'm necessarily seeing why oil and gas are up while we're not at the table, and the rhetoric seems to continue to be interesting and conflicting, to say the least. It looks like we're sort of still on track, dollar stronger versus most currencies. So, here you have it. Well off best levels post non-farm. We didn't hold the 100 handle on 5.5s or the 102 handle on 6s. 6.5s continue to lag. 10s at 466. And so how do you play this? Well, it's getting really interesting because, in a lot of ways, keep in mind, Fed dual mandate here, employment and inflation, and we were mixed in some respects last week. The ISM inflation numbers, net, I would say generally bad for bonds, but not terrible, slightly neutral-ish, and, other than claims, the employment situation just doesn't seem great. So you got to wonder if that gives the Fed a moment of pause. I just don't see a September hike if all things are equal, and I don't see all things being equal. I see the data getting worse. I don't see why it wouldn't. So I've said many times, right, that the market's never wrong. So I'm not going to use the word wrong here. I do think that the market is offside. I think we're playing protect, and make no mistake, there is risk weighted to both sides. the risk of oil going back to 90, the risk of a hot CPI number here in a couple of days. But I think at a minimum that's counterbalanced by the risk of the employment situation worsening. And the data, generally speaking, hasn't been great. Weak GDP number. And if you're worried about the inflation numbers, we've been moving in the right direction the last few months. So, I just don't see it. I think, as I indicated on Friday, I don't think Friday's number was the end-all be-all. So, I'm sure you've heard this from me before. I play it kind of day to day on the near term, and my longer term outlook for rates is even more bullish after Friday than it had been accumulating to an almost, not quite, full-on guarantee that we're going to see the same August, September, October for interest rates that we've seen the last few years. The data is headed in that direction, and I think the only thing that can really stop us is Iran. And there was, I'm just going to pull up some quotes, but there was let me Google this, but, President Trump talked about letting it breathe or something like that. Another quote, semi-negotiating. I mean, I don't know what that means. I'm sorry. Low-keying it. I thought he said was letting it breathe. But, so, even in that mixed messaging, right? But what's the quote? It'll work. So we're only... President Trump said in a new interview that he's low-keying it when it comes to the war with Iran as it nears 6 months. We're only semi-negotiating with them. We're watching Iran with its huge inflation and the fact that they had no money. President also said Tehran's economy is in very bad shape and that its country cannot compensate its forces. It will work out as it always works out. It's like a chess game. And you've heard me say that. And I don't know that I agree that it always works out, but I've said this a million times. If he's nothing, the president is a salesman. He's a negotiator. He tends to negotiate from strength, and when you negotiate from strength, part of that's sort of being a bully, right? And he's bullying them a bit right now. In theory, we're the 800-pound gorilla, and they're not. So I know that we all would like to see this end, but the longer this goes on, I think that the better shape that we're in for the reasons he's given. Average price of gas was about $4 on Monday morning versus $3.14 a year ago. I think that the headline that I saw overnight that I wasn't crazy about is that that Israel rejected our Hamas deal. I actually think that's bigger news. Not bigger news for inflation, but bigger news for the complexity, if you will, of the Middle East. Long story short, Brent and crude up about 2%, gold, platinum down, natural gas up almost 4%. And we are testing an 80 handle on crude sitting at 79.58. So as you know, certainly bonds aren't going to love that. I just feel like, if we were to put a ledger, as we might, in a 1980 sales pitch, right? I think that the positives for interest rates far outweigh the negatives. I think that the negatives are a bit more attention or headline grabbing, but I just don't see it. To me, we should be at least an eighth, if not a quarter, less in yield on tens, and I think we should be, call it, 50 basis points better on MBS. Maybe 3/4. Believe me when I tell you, I'm not suggesting that we should be dancing any jigs here. But what I am saying is I struggle with the idea that we would be almost 100 basis points worse than, call it, June 15 levels. What have we seen in the last 60 days that would suggest that we're in an economy that's worsening from a bond landscape? Everything tells me that it's improving relative to bonds, that the economy is worsening, that the employment situation, notwithstanding claims, is worsening. And that actually inflation isn't as bad as we'd fear it to be based on oil prices. So I don't get it. Therefore, how would I trade this? Well, if I'm a loan officer, I continue to be day to day. I think 5.5s to 6.5s are certainly not full on lock, but they're closer to lock than they are to float. Call it 70% lock bias, something like that. I think as you get, call it an August 20th closing or forward, you're almost 100% lock. You took a chance and you should have locked on Friday had you not. But if you were giving it day to day, didn't go your way, you've got to, don't chase your loser. If I'm talking 5 coupon or less, 5 3/4 or less, that's where, to me, you can maybe take some chances. I have to tell you, I mean, over the last couple of days, we've been covering up our long position. We've gotten to a level on our chart that we liked. We took some coverage after the number yesterday or Friday, and then the market sold off. I mean, I think certainly the last few days from a cap market standpoint, easier to trade that data than it was, say, as a loan officer, because we can react to some of this stuff in real time. We were able to cover right after the number when we were up a half. And what did I say on Friday, right? I don't see this being up a point worthy. Now, unfortunately, that proved to be a prescient thought. So there you have it. I will just simply say all the talk online and at FAMP was UWM's earnings report. I really have no real inclination to talk about that beyond commenting on everybody talking about it. And here's what my 2 cents on it. Both sides are wrong. I think that the folks who are blindly supporting UWM don't understand. And I think that the folks who are trying to say that there's some sort of outlier or what they're doing isn't giving credit to everybody else who prices loans the same way that they price loans, and so on and so forth. I will say that the $600 million charge is pretty curious. And if there's one thing that folks should be talking about, arguably it's that. But certainly not business strategy, business philosophy, and even either sort of the blind. I don't even know what I'd want to call it. Sort of the blind support, I guess you will, of where the stock is, or the sweeping condemnation of how they do things. I think that you give their competitors, of whom we're not, at least at the moment, way too much credit. So I've said that before, and I say it again, is I think they're easy to single out, but I think it's wrong to do so. So there you have it. I will see you guys tomorrow. Thanks for joining live, watching on replay. And remember, bulls and bears make money, pigs get slaughtered.